Hello, everyone, and welcome to Schwab Coaching. My name is Cameron May. I'm a Senior Manager of Trading and Derivatives Education here at Schwab, and this is Trading Covered Calls and Short Puts. And today we're going to be talking about short-term income strategies. And specifically, we're going to be talking about selling covered calls on just a weekly basis. And we're going to be doing that using thinkorswim's strategy roller tool. So I think this is going to be a great discussion. It's going to be automating a weekly approach to income. A lot to cover. Before we can get to any of that, though, let me first of all say hello to everybody that's already chatting in out there on YouTube. Great to see so many familiar names as always. Hello there, Kevin and Lawrence, Jay Richardson, Will, Eva, Greg. Who else is out there? There's Mark and Ricebird and Tatiana, everybody else. Thanks for joining us week after week. We always do appreciate your attendance and your contributions to these discussions. If you're here for the very first time, I want to welcome you as well. And if you're watching on the YouTube archive after the live stream is concluded, we'll enjoy the recordings. A great way to watch these webcasts, but also be aware that you're invited to join us in the live stream if you'd like to be here. This is a Monday webcast series. We kick things off promptly at 2 Eastern time. We'd love to have you here in the live stream. Also, as a treat for my live stream audience members, my very good friend Barb Armstrong is going to be hanging out in the chats. She's going to be addressing any questions that come in through the YouTube chats that I can't get to just during the flow of the presentation. Thanks for having my back there, Barb. And Barb and I would also like to issue an invitation to everybody watching. If you have an account on X, you should be following your favorite Schwab presenters there on X. You can follow Barb there at Barb Armstrong CS. You can follow me on X at Cameron May CS. If you reply to one of my posts, I try to reply right back to you. Barb's very active there. Great place to connect with your favorite presenters in between the live streams. Now, I also want to let you know that starting just about a week ago, you can now contact me or connect with me through LinkedIn. So just look for Cameron May, track me down, give me a follow. Much smaller audience of followers there, so I'd love to have you as a follower on LinkedIn. But let's get right into this discussion. Now, of course, there are risks associated with what we're going to be discussing, so bear this important information in mind. Options carry a high level of risk and are not suitable for all investors. The information here is for general informational purposes only and should not be considered an individualized recommendation or endorsement of any particular security, chart pattern, or investment strategy. Schwab does not recommend the use of technical analysis as a sole means of investment research. Investing involves risks, including the loss of principal, and any investment decision you make in your self-directed account is solely your responsibility. Okay, so here's what we're going to be talking about today. First thing that we're going to do is have a look at our existing paper money trades, some practice trades that we have in place. We're going to be following up on those, see if any of them need any attention. I don't think we're going to be making any changes to those, just as a spoiler alert. Then we're going to take a quick peek at what's going on with the markets, which is it's just rocketing up again. Then we're going to plan and place a new covered call trade, sticking with about a week time frame, but we're going to be looking to use one of the tools on thinkorswim that may assist a trader in automating their approach to covered calls. Now, whatever that might be, we're going to be using sort of a weekly time frame for this example, but I think this is going to be interesting. We're going to be using that strategy roller tool. How many of you have used that strategy roller tool before? Just chat in and let me know. But with that, let's go right to the thinkorswim platform. We have 4 current positions, two stock positions. We've had covered calls on those in the past. No calls sold on those at the moment. We have 2 covered call positions that are active. So let's start with Amazon. So Amazon, we own 100 shares. We've had calls in the past on this. Here's what's been going on with that. You can see we bought these shares for $221.52. Shares are up marginally. They're at $227.71, so up about $6 on our share position. But along the way, we've also sold some calls. We closed out 17th of October, 235 call for a $1.40 profit. We closed out a 24th of October, 230 call for a $1.40 profit. This says calls. I'm going to edit that because it was just a call. Yeah. So let's just close. Let's change that. Make sure that it's accurate. In any case, so right now our break even after accounting for $2.80 of now realized gain is now down at $218.72. We have an earnings announcement coming up right now. We're going to make sort of the decision here that going over the earnings, I'm not going to sell a call and cap the upside potential on our stock position, but we are going to let it ride through that earnings. So could go well, could go poorly, but we will exit if our support breaks all the way back down here. All right, now before we go into our second trade, well, most looks like most of you have not used the strategy roller. Maybe you're just not familiar with it. That's okay. I'll walk through how it works. We'll use an example so we can get some repetition with it. It's not a solicitation that everybody needs to be using it, but we'll talk about how it might be used to maybe streamline a shorter-term income investor's approach to weekly contracts. All right, let's go back to our Bank of America. Here we own 200 shares. We've sold 2 contracts against that, bought the shares for $50.58. Those shares are now worth about $53, which is interesting because we sold the $53 call. We collected $1.27 for that. It's gone up a little bit in price, but we're getting closer to expiration as well. So here's what that looks like. This is a relatively recent position. Bought our shares here. We've already closed out some calls for $1.07 of profit here. Sold another strike up there, the 21st of November, $53 calls for the 127. Now they're worth about 20 cents more than that. Getting close to being in the money. That can raise the risk of early assignment this far out from expiration. That can have the opposite effect, to lower that risk. But even an out of the money contract, even some distance from expiration, could potentially be assigned. That would just mean somebody buy our shares for $53. All right, that would be a forced realized gain on those shares. Plus, we'd keep the premium. But we need to be aware that when we're selling covered calls, we're not in control of whether the contract is assigned or not. Right now, our break even for the premiums that we've collected, subtracted from the purchase price of the stock, is down there at $48.24. So next position, NVIDIA, pretty similar to our BAC position. Covered call, bought the shares at 184-ish. They're worth 191-ish, doing well on the shares. We sold the 195 call strike. So here our preference might be for the stock to stay below 195. And it is right now. It's at 191, but like so many other stocks, it's been going up. So let's see what's going on there. You can see that, yeah, stock's been rocketing up toward our strike, still out of the money, still some time to go. We sold before this next earnings announcement, so we didn't go out to that monthly expiration. Stayed just before, but that one's working just fine. You can see that's overall profitable trade. So we'll let that one continue to work. And finally, we have our Visa, just a stock position. Purchase shares, well, they were assigned to us at 330. They're now worth 347. A good reminder that assignment is not always a scary thing. This started back here. We sold a put and it expired. Kept that as we retained that as a realized gain. Sold another put. That put was assigned at 330. As our stock recovered, we started selling calls against that. Sold the 360 calls, realized a profit. Sold the 355 calls, realized a profit. So that's 4 premiums that we've successfully collected a premium and realized gains on. So we subtract those from the 330 strike, and our break even's down here at 320.56. Stock has been going up. Earnings right around the corner. We're going to let those shares ride through and then decide whether we're going to keep them or sell new calls. So that's it for our current positions. JDLMI says, why are you down NVIDIA call if you're below the strike 195? Oh, because the reason why our trade there is unprofitable on the call is because it was further out of the money when we first sold it. So even though it's still out of the money, it's much closer. It's essentially been moving in the wrong direction for the call. Calls have been becoming more expensive. When we sell a call, we typically have the preference for the calls to become less expensive. There you go. Good question. All right, but we're done with our current positions. Let's go see what's going on with the markets. Looks like they had a productive round of discussions between the U.S. and China on that trade front over the weekend, and the markets liked it. Now, there could be a number of other factors playing a role here, but whatever the case, all-time highs, and we are trading right up there. Let me get specific here. If I point at today's candle, the highest point the S&P 500 has ever touched is 68.62, and we're at 68.61. Yep, so pretty bullish. Now, this could turn on a dime. The trader never knows when that event might occur. However, This has been a really nice run for the bulls, including those seeking income from bullish strategies like selling puts and selling covered calls. So we're just going to keep it up. Now we're going to be planning a trade, but not going all the way out here to November. I wanted to talk about weekly income this time. So let's use an example stock. And the stock that I'm going to be using today is Broadcom. Why Broadcom? Or why stocks like Broadcom? Well, I can't speak for every covered call trader out there, but there are a few things that tend to be fairly, not entirely universal, but fairly common among covered call traders when considering a stock candidate. One thing might be the price per share. The more expensive the stock, the more it costs to buy in order to pursue a covered call. All right, that's a consideration. Also, liquidity. Liquidity can be a big concern, but especially for those that are selling weekly contracts. Illiquid stocks, smaller stocks, less liquid stocks, tend to not even offer weekly contracts. Even the larger, more liquid stocks among those, if there are weekly contracts available, a lot of those have very wide spreads between the bid and the ask, reflecting poorer in comparison to stronger liquidity, less liquidity, meaning not a lot of volume trading. So one point of emphasis for a trader, in addition to price per share, might just be lots and lots of trading volume on the stock, which might trickle through to lots of trading volume on that stock's options, narrowing up those spreads, maybe making it more liquid to get into and out of positions, not as wide of a spread, might also just make it easier to trade profitably. Now, that's not saying that we're guaranteed a profit. It's just less difficult than illiquid options. All right. Now, finally, maybe a trader, well, it's not finally, but there are lots of other things. They might be looking at a sector. They might be looking at the fundamentals of the company. But another thing that a trader might consider is what has the stock price been doing on its chart? And with Broadcom, it was already having a nice run, had a great earnings announcement right here, where we saw a gap up. The top side of that gap has acted as a pretty good price floor, and it looks like we might be starting to make a resumption of the previous upward trend. So let's just say that our trader thinks prices are likely to go up for a while, and maybe they don't want to cap earnings for too long. Maybe they just want to do this every week. In any case, whatever the motivation is, we're going to be doing weekly contracts. So what are some of the pros of doing weekly contracts? Let's weigh the pros and the cons. Well, when selling options, the fastest time decay, the greatest per day potential for return most commonly happens right in those days right before expiration. And so for some income sellers, they like to sell those contracts that are getting right up against their expiration date, because their theta, their time decay, may really be kicking in. So that's a pro. Let's balance it with a con. Now, Mark says faster time decay. What's a con? Well, if the trader has a preference for whether they retain ownership of the shares or not, they're kind of dancing on thin ice here. Because even if we sell an out-of-the-money contract, out-of-the-money contracts can be assigned, but if the stock makes an unexpected move in a short period of time, there's not much time left before expiration. Not much time for recovery to take us back out of the money if that's what the trader is looking for. Also, there may be a stronger incentive for those in-the-money contracts, since so little time remains till expiration, to be assigned and shares to be purchased. So selling weekly contracts may not be for that trader who prefers to distance themselves from the probability of assignment as much as possible. This is not their place. All right. Mark also points out there can be less liquidity, right, Mark? That's why I really emphasized the liquidity at the outset of this. Yep, contracts that are shorter term, they can tend to be a little bit stickier to try to get into or out of. So what might be the offset for that? Well, just try to avoid it as much as possible by going with some of the most liquid companies out there. Broadcom could probably be numbered among those, considering its where in total size right now. Let's look at the watch list of the S&P 500. These are the biggest companies in the world. NVIDIA's number 1, Microsoft number 2, Apple number 3, Amazon number 4, Broadcom number 5. So if we're looking to optimize liquidity as much as possible, it's tough to get much better than that. All right. Good point there, Mark. What else? Well, if we're doing weekly contracts on a regular basis, we are going to be paying more commissions. That's not as much of a consideration as it once was, but it's still a consideration. Getting into and out of contracts more rapidly, higher turnover rate, yep, is going to increase the number of commissions ultimately being paid, which hopefully are being offset by the larger per day premiums being collected. But JRT correctly points out they're larger per day, but smaller overall. Yep, premiums that are closer to expiration are going to be smaller, but actually have larger daily time decay, proportionally larger daily time decay. So there are pros and cons to this approach. We need to be aware of both sides of the equation if the trader's trying to make an informed decision about whether they're going to be pursuing this. So I'm going to be doing one. Let's set up just a weekly contract. Now, we could go out. I think there are contracts at 4 days, contracts for 11 days. Let's have a look for Broadcom. Actually, let's tie it to our chart behavior. You'll notice recent highs struggled to get above about 372.5. And I've drawn in a line here. These are the contracts that are expiring at the end of this week. This is a Monday webcast. So we have contracts that are expiring on Friday of this week, only 4 days out. So maybe our trader is trying to decide, well, do I sell this Friday's contracts or next Friday's contract? Well, let's go see if we might be able to get an adequate, throw that in air quotes, an adequate premium for just a 4-day contract. Let's go to the trade tab. Let's stick right here, the very first expiration, 31st of October. Ooh, that's spooky. Literally, we'll call them the Halloween contracts. 4 days from now. And what if we're trying to sell a contract that's at or above those recent highs? Trying to minimize the likelihood of assignment. Now, assignment, would that be disastrous in this trade? If we bought the shares right now for 360, low 360s, and then we wind up selling them for, let's say, low to mid 370s, not a disastrous outcome. That would be a profitable outcome if assigned. But let's just try to maybe sell up above that resistance. And that was up there at 372.5. And it looks like there's about maybe $4.75 that might be possible there. A little bit more than 1% for a 4-day contract. All right. What if we pushed it higher? What if we went all the way up to 380? That's closer to $3, maybe $2.85, $2.90. That's a little shy of 1%, but only 4 days of an obligation. So let's do that. Mark's saying lots of implied volatility for the 31st of October options. Yeah, when premiums are kind of high, the trader might do well to stop, check headlines, see if there's an earnings announcement. In this case, there's not an earnings announcement. We just had earnings back in September, so it should be October. November should be the first part of December. Earnings aren't a consideration here. Now, also, just some stocks just move. You look at the way this thing moves. These just look like normal candles, but this was a $335 stock 4 days ago, and now it's a $365 stock. You can see why options traders might be willing to pay a higher premium, higher prices for more volatility. Okay. Art Vandalay says, why not sell a put on AVGO? Well, we could, Art. I just decided to talk about covered calls today. If we're talking about the same stock, same strike, same expiration, everything the same, there's really not a huge difference between the two strategies. So one could be traded essentially with the same motivations as the other. Okay. But should we sell this 380 right up here? So here's what we're considering. I'm going to pull down this right margin a little bit. You can just grab the right margin, drag it down a little bit if you want to see things a little bit more clearly. You know what? Kind of want to zoom in. This is going to make it possibly a little bit easier to see. I want to see that 380. In any case, we're looking at maybe selling a call. This is going to put it in sort of visually realistic terms. Going to sell a call right up here and carry it out through there. 31st. Let's make that precise. Right click, edit its properties. Let's put it at 380 to start, 380 to end. Go to red color. That is the call. So that just it gives us a visual reference point to see how much distance we have between the current price of the stock and our strike price. And there's our expiration. So really what we're looking for here is for the stock to stay below 380 by that 31st of October, to just see this contract just expire worthless. So I'm going to do that. Now, NV Trader says, does Charles Schwab track the list of trades made in paper money? It does. Yep. Now we can track it, just not for today. So here we'll see all our filled orders for today's trade activity. It also keeps an account statement, just like a real account, where we can go back and look at historical trades. And yes, you can see these webcasts. That's another good question. If you weren't here to see a previous webcast, like if you want to go back and see last week's webcast and see why we did the trade we did and why it's turning out the way it is this week, you can go to our channel on YouTube. So if this is your first time watching one of our webcasts, welcome. It's great to have you here. But do yourself a favor, click on the subscribe button. It only takes a second, doesn't cost anything to do that. But our Trader Talks Schwab Coaching webcast channel is where we house the live streams right here, but also the playlists of previous webcasts, and we just organize them according to their series name. So if I go to playlists, I can scroll down. It's sort of in the middle for this webcast series. There it is, Trading Covered Calls and Short Puts. If I click on View Full Playlist, you can see there's last week's discussion, the dark side of covered call income strategies, 3 big risks we talked about last week. And you can see all the previous ones right there. Okay. So thanks for asking that. Very good question. Let's put on our Broadcom trade, though. For this one, 100 shares is going to cost us $36,000. Okay. Traders need to be aware of how much money they're spending to do their covered calls. And then let's sell maybe that 380 call, maybe getting somewhere close. Looks like maybe 290. So the net on this, it's probably going to cost us about $359 per share, paying basically maybe 358, something like that. If we're spending $361 to buy the shares, but collecting $3 per share on the contract, there you go, 358 net. So I'm going to come down here to our 380. I'm going to right click on this. Let's put in an order to buy a covered stock. That's just thinkorswim's term for a covered call. That creates a buy order, not for 100 shares, but for 1,000 shares. So let's change the contract quantity, and it automatically changes the share quantity to match, buying 100 shares of Broadcom. And then we're going to sell the 31st of October, 380 call. Looks like a net debit might be, as I mentioned, around 358. Let's say that we're willing to spend a little bit more than that. Let's take it up 358.44, the natural. That might have even gotten away from us a little bit more. I'm just going to call it 358.50 net. I'm doing this just in the interest of time. The webcast time is ticking. I want to get this order in so that we can then set up a rolling order for future trades using that strategy roller tool. So let's hurry up and click confirm and send. Looking to buy this covered stock or covered call position for not more than $358.50 net between the purchase and the sale. There is a commission to be paid on the short call. And please note that I've selected a weekly option series with a non-standard expiration date. Yeah, that was kind of the point of the discussion, right? So let's send this order off. See if we can get a quick fill here. Let's go to our working orders. Oh, it actually did fill. We offered to pay up to $358.50. It cost us $358.27. Or in other words, we bought the stock. Let's go to our filled orders. Bought the stock for $361.10, sold the call for $283. So that's now down here in our current positions. Now, that's nice. We're now into a weekly covered call, and really the trade here is we're just hoping the stock goes up, which is great for our stock ownership, but stays below 380, which might mean we just keep that call premium and let it expire worthless. If we are assigned, okay, we bought the shares for 361. If we have to, if someone buys the shares from us, we sell them for 380. Is that a disaster? A $19 profit on the stock? Nope. Not necessarily. In any case, 4 days till expiration, though, and let's just say we have future Cameron, future trader in mind here. We already know what we would do later this week to manage this trade. Let's say that our trader just has a preference. Maybe this is their approach. They sell weekly contracts. And so every Thursday or every Friday, they find themselves coming back to their computer and setting up a trade. Well, let's get out of the current one. Let's roll this into another trade for next week, and on it goes. Well, wouldn't it be nice if we could just automate that process so we didn't have to come back on Thursday and Friday and place the closing transactions and the new opening transactions for next week? That is potential. We can potentially do that with a strategy roller, which is a tool that's been designed specifically with the covered call trader in mind to automate this process. So let's do it. A couple of different ways that we can use the strategy roller. Number one, Mark says you never sold an option in less than 10 days to expiration. It's new territory for you. Well, welcome to the new territory. Again, of course, this is not my invitation that everybody should be doing this. This is just an example, right? There are pros and cons to every approach to trading. So we just are discussing another approach today, okay? But the strategy roller tool, we can actually, if we click on that strategy roller, the system knows where we have covered calls and it will just line them up for us right here. These are considered our eligible positions for using the strategy roller tool. I didn't have to do anything to import this into the tool. They're already there. There's that Broadcom position we just took. So if I open that up, I can see there's our weekly contract expiring in 4 days. And watch this. I can click right on that and it gives me access to setting up this automated process. And this looks kind of intimidating. It's really not. We just read down through it. It's a step-by-step process. But that's one way to access our strategy rolling. Now there's another way. So I'm going to come down here and just cancel from here. No harm, no foul. We haven't done anything yet. So we can go to the strategy roller tool, or if we're just here looking at our position already, we can just right click on it. So I'm going to right click on this call, right click, and create a rolling strategy. So there we are. We're basically, if you'll notice what that just did, it took us over to the strategy roller tool and it loaded up Broadcom. So it's showing us that we're doing something with that Broadcom position. We own 100 shares of the stock and we're currently short a 31st of October 380 call. Well, as we go down and fill out the rest of this left column, now over to the right is sort of just a chart. So we can use that for visual reference. I will say, though, that when using this tool here, chart isn't going to really play much of a role. It's really going to come down to the numbers of the option. Let's see, Josh says, regarding the strategy roller, a couple of questions. Is there a way to change delta to 20 cents versus 25 cents? Yes. Can you select it based on open interest or volume? No, not without let's say a custom script. Okay, so it's a fantastic tool. Of course, just like any tool, our imaginations can explore different ways that, ooh, if I could create this tool in my universe, there are different things that I might add. We kind of have to strike a balance. I can feel the stresses of our poor engineers who they're every bit as imaginative as we are. And they have to strike that balance between what if I put in every single permutation of every possibility for setting up a roll? That would be awesome, but it would also be incredibly complicated to navigate. Or on the other side of that balance bar, well, how about we just keep it as simple as possible without eliminating too many really sort of vital tools? Okay, so that's it. That's my best excuse for why this isn't on there, Josh. Anyway, let's fill this thing out. So first of all, we tell it the quantity that we intend to roll. So if you're not familiar with rolling just means we bring up an order ticket and we fill it out to get out of one trade. And then on the same order ticket, we're going to get into another trade related to the first one typically. All right, that's what rolling is, rolling out of one and into another. And this just sort of automates that process. So the first thing we do is we tell it how many contracts are we getting out of and into. And you might think, well, Cameron, you'll have one, so of course it's one. Well, not always. So let's say that our trader has 3 contracts, but they only want to automate the rolling of one of them. So in this case, yeah, we're just going to do this one. Then we select a couple of different ways to select our strike price. So the system knows we're getting out of the current strike, but it doesn't know which one we want to choose for the next week. So we could just go, let's say, a certain number of strikes out of the money. So on our trade tab, on this one, just sort of coincidentally, the stock right now is at 361. Let's split some hairs, actually. The 362.5 would be considered the technical at the money strike. So out of the money would be 1, 2, 3, 4, 5, 6, 7. But it's not always going to be the case that it's always going to be 7 strikes out of the money to get an equivalent or a similar-ish premium or probability. Okay, but let's go back here. Anyway, we can choose number of strikes to go out of the money, though. That's one way that we can do this. Or it's an either or we can go with a delta. Eva says, is the strategy roller usable if the covered call is at the maximum with leaps? No. Nope. That would be a diagonal spread, right? So some people refer to a diagonal spread as the poor man's covered call or the poor trader's covered call. No, this is exclusively for covered calls. Legitimate ownership of stock, short call contract. Yep. All right, so this is possibly, I don't know, in my experience, the more common way to set this up, but not everybody agrees with that. So don't, take that for what it's worth. But our delta, Josh says, can we use a different delta? Yes, we can click on that delta and you get a slide bar and it says 25, but actually if we use a slide bar, we can go in increments like this. So for example, let's say we just want to roll to that 30 delta. What we're telling the system is, hey, get me out of this contract. And then for next week, whatever the 30 delta is, what was our delta on the one that we chose, by the way? Well, how about we just be consistent here? Our 380 is actually a 23 delta. Interesting. So let's go back here. And let's nudge this down closer to that lower end. You know what? I've never actually gone below a 25 delta. Josh, maybe there's the answer to your question. All right, we'll go with 25. Anyway, so this is just going to roll automatically out of the current contract and into the next week, the 25 delta. Do we know come Thursday or Friday or whenever we set this up to roll, do we know what the delta is going to be on the one that we're in at that moment? How much it's going to cost to get out of it? Nope. We don't know that. But so there are, I wouldn't call that a limitation. That's just a fact of the way options work. We just have to be aware that at the moment of rolling, we're not always in control of whether it's a profitable trade at that moment or not. All right, but we're going to roll out, let's say we can go out a week, we can go out some other time frame. But for this, since we've selected the weekly contracts, it's going to default to that weekly contract. And it's giving me a reminder that it's just going to roll out to that next week or the one that's closest to it at the time the roll is attempted. There are some additional options here. Let's see. Ambrose says, how do we know with the auto rolling what we get or what we pay? Ambrose, we do not know. Don't know it. Yeah. When we, it's kind of like a trail stop. When we set up a trail stop to sell us out, how do we know what price we're going to sell for? We don't. Even if we use a traditional stop, we know maybe approximately, not a guarantee though. Yeah. Okay, Vic says you put down what you want for the premium while rolling. Well, Vic, you put down where you want this executed in regards to the bid or the ask, but it doesn't actually ask you a minimum or maximum premium acceptable. In any case, right here it's asking us begin strategy. What does that mean? Well, this is telling us when do we want this roll to go into effect. Right now we're 4 days from expiration. So do we want it to be the day of expiration, 2 days before expiration? And so this is up to the trader. Do we want to kick this off, start the attempt to roll on maybe a Thursday? And I'll tell you, when we put this order in, it doesn't mean if we put in 2 days till expiration, that's the moment the order is placed and filled and done. No, that's when it will start trying to do what we want it to do. But it might actually go all the way through a certain time on the Friday of expiration. So I'm going to start my effort to roll 2 days before expiration. Now, right now, that's not actually giving us a lot of time for time decay, right? We're 4 days before, and then we're going to try to get out 2 days before. Time decay, probably not going to play a huge role. It'll play some role, but price is probably going to play a bigger role here. In any case, next up, it's going to ask for your order price, but it's not asking, well, I want a $3 credit or a $5 credit. Instead, it's saying, Cameron, do you want to try to get the natural? Do you want to get closer to the mid as you're selling? And for this one, how about we just dial this up? I'm going to set this to 75% of the natural. What this is saying is whatever the price of the contract is, the system will automatically, 2 days before expiration, start trying to get us out of our current trade, and it's going to try to do that at the mid price first. It's going to try to get us the best deal, but I've just given it permission to work its way toward the natural. So it'll try to get out for the mid price. If not, it's going to work more and more and more toward 75% of that natural, getting closer to the market price. Then we can tell it what time of day we want this to go into effect. Now, for me, let me scroll down just a little bit further. You can see down here at the bottom, I'm actually here in Mountain Standard Time, or Mountain Time. You'll notice these times, for my system at least, are for Central Time. So I have to make a 1 hour adjustment here. So just make note, come down and read through this summary to make sure of the precise time that this is being entered. But I'm going to make this active. Let's say it's active at 8:45. That's a.m. This is sort of what we call military time. 14:45 would be 2:45 in the afternoon. But at 8:45 a.m. Central Time, or 7:45 here in the mountains, 2 days before expiration, it's going to start attempting to roll, right? Then, and we could cancel this at a specific time. I'm going to leave that open. So between 8:45 and 9, it's going to attempt to start rolling. Then I have this option to move to a market order. It's going to move to a market order. It's going to try to get an optimized fill at the mid, maybe up to a maximum going up to 75% of the ask. But at 11 o'clock, I'm just going to leave this 11 o'clock. It doesn't have to be 11 o'clock, but 11 o'clock on Friday, it's going to just switch to a market order. And it's going to say, I'm going to get this roll accomplished no matter what it takes, basically, a market order. There we go. Now, with all of this entered, and you might need to go through, watch this archive a couple of times just to sort of get exactly what we're doing here to set up this roll. But basically, this is just going to continue doing this in the future on Thursday at 2 days before expiration. This is going to try to get out at 75% of the natural or less, roll to the next weekly expiration, starting at 8:45. On Friday, it's going to switch it to a market order to optimize the likelihood of getting this roll accomplished. And that's it. Okay, now let's see. Oh, there's a survey. Yeah. Let me hit the pause button there. Before we read this, and then I'm not going to confirm and send because it's not possible in paper money. I can do a demonstration, but I can't actually click the send it off button But there is a survey, so thanks for calling that out for me, guys. We don't get this opportunity in every single webcast. So if you're here in the live stream, do me a favor, click on that survey link that's been put in the chat window there. I want to tell you a couple of things about that survey. It's only 2 multiple choice questions and then a comment box and a suggestion box. Very straightforward survey. It only takes a minute or two to fill the thing out. But if you take the time to fill that out, I'll take the time to read it. That data always helps. I read through those comments. I sometimes plan my webcasts around those comments or as a result of those comments. So it's never wasted effort, guys. Thanks for doing that for me. But back to our roll. Let's just read through our summary. This is the trader's final opportunity to make sure that they're doing exactly what they intend. This strategy will roll your Broadcom 31st of October 380 call to the 7th of November call nearest to the 25 delta starting 2 days before expiration. A limit order will be placed at 8:45, between 8:45 and 9, priced at the mid if the trade on the first day of the strategy, of the trade, should say of the trade, not if the trade, but of the trade, on the first day of the strategy and moving incrementally towards 75% between the mid and the natural on the final day of trading. If the rolling order has not filled by 11 o'clock Central Time on the final day of trading, it will be replaced with a market order to roll between 11 and 2:45 on that day. And if we're okay with all that, how we've set that up, we'd click confirm and send, but look at that. It's an inert button because this actually isn't a feature of paper money that can be activated. You can practice with it, but not actually send it into practice, right? There we go. So guys, I just wanted to introduce you there to that strategy roller tool. If that's your first time seeing it, yeah, experiment with that in paper, but we're not going to be automating this one in particular. This is a paper money account, so we're going to be managing this one manually. So we'll keep an eye on Broadcom in the future. We'll see if the stock gets up above 380, decide what to do with it in, well, we won't decide what to do with it. No, yeah, we're not even going to see this thing before next Monday. It'll decide what it's going to do on its own because we're going to meet next Monday and see what happened, basically. In any case, everybody, time for me to let you go. Go experiment with the strategy roller if you haven't used it before. Barb, thanks for helping out in chat. It's always appreciated, but I have some suggestions for you before you shut off this webcast and go get ready for the next one. First of all, make sure that you have subscribed to our Trader Talks channel. As I mentioned earlier, this is where we house our live streams. You can also view our playlists right here. So yeah, go down below the stream right now, click on the subscribe button. It only takes a second. It doesn't cost anything, but you can join those live streams. You can go through the playlists according to the different series of webcasts. You can even do searches according to specific keywords of specific interest to you. And it'll just find related webcasts from Schwab. Another suggestion I have for you is that you follow Barb and me and all of your favorite presenters on X if you have an account on that platform. So for example, I just posted on X about what's going on with Qualcomm. Qualcomm's going crazy right now. It was up 22% earlier today, pulling back to about the midpoint of the candle. And I just want to get my followers' input. Where do you think we finished the day? Closer to the bottom of the candle, back up closer to the high, or somewhere in the middle? And we can have these sorts of conversations, learn about trading. It's just a different way for us to communicate when the camera's not on. Now, a final thing that I want to let you know is that you can now connect with me on LinkedIn. And an advantage to LinkedIn, and I'm just sort of working out the kinks of my LinkedIn approach since I just started my LinkedIn profile last week. I'm going to do sort of longer form stuff here. So X is fabulous, but I have a character limit. On LinkedIn, I can get a little bit more in depth. So I plan to do that. And if you reply to one of my posts here, I'm going to reply right back to you as well. So yeah, if you don't have the account on X, or if you have accounts on both platforms, you want to follow me on both, there's advantages to both. Love to have you there as a connection on LinkedIn. Barb, thanks for help again in chat. Thanks for reposting that survey, everybody. Last opportunity to fill out that survey. I'm going to let you go. Enjoy the rest of the webcast for the rest of the day. I will look for you in a future webcast. I'll also look for you on X. I'll look for you on LinkedIn. But whenever I see you again, until that moment arrives, I want to wish the very best of luck. Happy trading. Bye-bye.